Stocks don't just rise and fall randomly. They move through stages, just like a growing plant. Let's break it down in simple terms and avoid some of the common traps investors fall into. 1. Accumulation. The stock has fallen or stayed quiet for a long time. No one's interested. But smart investors? They're planting seeds, quietly buying. Rising volume with little price movement means smart money is moving in. 2. Markup. Now the plant starts growing fast. That's when people notice. The media talks. Everyone wants a piece of it. Just like plants, the fastest growth happens in the early stage. Don't wait for headlines. Spot the early growth. 3. Distribution. The plant has matured. Growth slows. Smart investors start harvesting, selling quietly. But the crowd? Still buying, expecting it to grow faster. Don't fall in love with a stock. Even the best ones stop growing. 4. Decline. No more demand. The stock starts falling fast. News turns negative. People panic. Some keep watering, hoping it'll come back. Some even pour in more money to average down. Don't average down blindly. Cut your losses early. Hanging on forever is not a strategy, it's a trap. So what happens after decline? Some stocks recover years later, some never do. Veterans don't wait and wish. They move on to find the next seed to plant. Your capital is more valuable than your emotions. Here's the full cycle. 1. Accumulation, smart money buys. 2. Markup, trend builds. 3. Distribution, smart money exits. 4. Decline, panic selling. And after that, you either wait years or find a better opportunity. The stock market rewards those who observe, adapt, and act, not those who stay stuck in hope. If this helped you, hit subscribe and share it with someone who needs this wisdom. It helps us make more honest, clear, and simple videos, just like this.